In May 2026, Alibaba reported something that should have terrified its shareholders. Core profit had collapsed 84% year-over-year. Free cash flow, the actual cash a company generates after paying its bills, had swung from a 3.7 billion yuan inflow to a 17.3 billion yuan outflow in a single quarter. For the full fiscal year, Alibaba burned through 46.6 billion yuan more than it brought in, a swing of over 120 billion yuan compared to the year before. Normally, numbers like that send a stock into free fall. Instead, Alibaba's shares jumped. Investors weren't panicking, they were celebrating. To understand why a company can lose money hand over fist and still make its shareholders happy, you have to understand what Alibaba is actually building. This isn't a company in trouble. This is a company making one of the largest, riskiest, and most consequential bets in the history of Chinese technology. It is trying to build, from scratch, an entire parallel AI universe that doesn't depend on a single American company. Not Nvidia's chips, not OpenAI's models, not Microsoft's cloud. Every layer, from the silicon to the software running on your phone, made in-house in China, immune to the next round of sanctions. And the price tag for that ambition is staggering. Alibaba has pledged to spend at least 380 billion yuan, roughly $53 billion, over 3 years on cloud and AI infrastructure. Then in May 2026, CEO Eddie Wu stood up on an earnings call and said something even more remarkable. That number isn't enough. Demand is so strong, he said, that Alibaba will likely need to spend more on computing power in the next 5 years than it had originally planned to spend in 3. This is the story of what that money is actually buying, why Wall Street and Chinese investors alike are willing to stomach the pain, and what it means for the global AI race when the world's most cost-conscious e-commerce company decides that losing money is a strategy, not a mistake. Start with the hardware, because that's where the story gets genuinely strange. Alibaba is not just a cloud company that rents out Nvidia GPUs to businesses. Since 2018, it has run a secretive chip design unit called T-Head, buried inside its Damo Academy research arm. For years, T-Head quietly built networking chips and low-power processors that nobody outside the industry paid much attention to. That changed the moment the United States began tightening export controls on advanced AI chips heading to China. Suddenly, having your own silicon wasn't a nice-to-have, it was survival. T-Head's answer is a chip family called Zhenwu, named after a Taoist deity associated with the north and with water, a fitting name for a piece of silicon designed to keep the lights on when the taps from Nvidia get shut off. In April 2026, Alibaba and China Telecom flipped the switch on a data center in Shaoguan, in Guangdong province, built around 10,000 of these Zhenwu chips networked together. That might not sound like an enormous number if you're used to hearing about 100,000 GPU clusters from American hyperscalers. But the significance isn't the raw count. It's the fact that every single chip in that cluster was designed, and in large part manufactured domestically, with no dependency on a foreign supplier that could cut it off overnight. Alibaba said the cluster could already train models with hundreds of billions of parameters, and that it was designed from the outset to scale up to 100,000 chips. Alibaba Cloud described the milestone as a shift from what they called high-end performance breakthroughs toward large-scale industrial implementation. Corporate language for "we've proven the concept works. Now we're going to build a lot of them." By February 2026, T-Head had already shipped 470,000 chips in total, generating roughly 10 billion yuan in annual revenue on its own. That's not a side project anymore. That's a real chip business, growing inside a company most people still associate with online shopping. And in July 2026, at the World Artificial Intelligence Conference in Shanghai, Alibaba Cloud went a step further, unveiling something called the Lingjun Zhenwu M890, a ready-to-deploy supernode that packs 64 chips into a single high-speed interconnected unit, available through the public cloud. It supports the low-precision math formats, FP8 and FP4, that make training massive AI models more efficient. And Alibaba says a single one of these units can handle inference for mixture of experts models, with tens of trillions of parameters. In plain terms, you no longer need to build your own custom AI supercomputer from scratch. You can rent a slice of Alibaba's, pre-assembled, pre-optimized, and running entirely on Chinese-made chips. It's worth zooming out here, because Alibaba's chip push isn't happening in isolation. It's one piece of a much bigger coordinated scramble across Chinese tech to build a computing stack that survives without American technology. at the very same World AI Conference where Alibaba showed off its Lingjun supernode, a company called Sugan, formerly known as Dawning Information Industry, unveiled something called the Dawning 8000, nicknamed Dengfeng. It's the country's first fully domestic AI supercluster, capable of supporting more than 100,000 homegrown computing cards, and it's already been wired into China's national supercomputing internet, a nationwide network that now links together an enormous pool of aggregated computing power. Huawei showed up with its own rival system, the Atlas 950 SuperPod. Baidu's chip division, Kunlun Xin, showed off supernodes of its own, already in mass production, and underpinning all of it is a quieter but arguably more important story. SMIC, China's largest contract chip maker, has moved into volume production of chips at what's called the N+3 node, roughly equivalent to 5 nanometers, without using the extreme ultraviolet lithography machines that Western export controls have blocked China from acquiring. Instead, SMIC engineers achieved it using a technique called self-aligned quadruple patterning, essentially running older deep ultraviolet lithography tools through multiple passes to squeeze out finer detail than the equipment was originally designed for. It's slower and more expensive per chip than the cutting-edge Western approach, but it works, and it means China's chip industry isn't waiting around for permission. Why does this matter for Alibaba specifically? Because none of Alibaba's chip ambitions happen in a vacuum. Tehed's Zhenwu chips still need to be fabricated somewhere, and the health of the entire domestic chip ecosystem, from SMIC's fabrication lines to companies making the specialized memory and networking components, determines how fast and how cheaply Alibaba can scale. When SMIC hits a 5 nanometer milestone, or when Sugan proves a 100,000 chip cluster can actually run in production, it lowers the barrier for every Chinese tech giant building its own AI infrastructure, Alibaba included. This is less a solo sprint and more an entire relay team, with Baidu, Huawei, Sugan, SMIC, and Alibaba all running different legs of the same race toward computing self-sufficiency. Here's where Alibaba's strategy takes an unusual turn. If you're spending tens of billions of dollars building your own chips and data centers, the obvious move is to lock up the AI models running on top of them and charge everyone through the nose for access. Alibaba did the opposite. Its Qwen family of AI models is, for the most part, open weight, meaning anyone, anywhere, can download the actual model and run it themselves, modify it, or build products on top of it, largely for free. By mid-2026, Qwen open-weight downloads had passed 1 billion, with more than 200,000 derivative models built on top of it by developers around the world. That makes it, by a wide margin, the most used open model family on the planet, ahead of anything coming out of Meta or Mistral. On the frontier end, Alibaba isn't holding back either. Qwen 3.7 Max launched in May 2026 as a closed, API-only flagship model, with a 1 million token context window, competing directly with the best that OpenAI and Anthropic have to offer. Alongside it came Qwen 3 Coder for software development, a video generation model called Wan 2.2, and in August, an image generation model called Qwen Image that topped Hugging Face's trending model charts the same day it launched. There's also Coder, an agentic coding platform designed to let AI handle real software development work with minimal human hand-holding. Why give away your best technology for free while spending billions to build it? Because in the AI industry right now, distribution is the real prize. Every developer who builds a product on Qwen instead of an American alternative is a developer who is now, in some sense, locked into Alibaba's ecosystem, likely to eventually pay for Alibaba Cloud's paid inference services, enterprise support, or fine-tuning tools. It's the classic razor and blades model, except the razor here happens to be one of the most capable AI model families in the world, handed out for free to win the war for developer mindshare before OpenAI, Google, or Meta can lock it up first. The strategy has an internal name inside Alibaba, the Alibaba Token Hub Business Group, a unit created specifically to knit together the Qwen models, an enterprise agent platform called Wukong, and consumer-facing apps into one seamless pipeline from raw model to paying customer. The Qwen consumer app alone had passed 200 million monthly active users by mid-2026, and Alibaba's AI glasses under the Quark brand began expanding internationally, starting at Mobile World Congress. None of this comes cheap, and the financial picture inside Alibaba right now looks genuinely uncomfortable if you only look at the traditional profit numbers. In the March 2026 quarter, Adjusted earnings before interest, taxes, and amortization came in at just 5.1 billion yuan, an 84% collapse from a year earlier. In the December quarter before that, non-GAAP net profit had already fallen 67%, even as headline revenue grew a modest 2%, or 9% when you strip out one-off items. Capital expenditure for the full fiscal year hit 126.1 billion yuan, up sharply from 84.3 billion yuan the year before, almost entirely driven by data centers and chip infrastructure. And the segment Alibaba calls all others, which includes early-stage bets like the Qwen consumer app, quick commerce, and other technology investments, posted a loss that grew more than 500% year-over-year, from 3.4 billion yuan to over 21 billion yuan in losses in a single quarter. If you only read the income statement, this looks like a company in crisis. But Alibaba's leadership has been remarkably blunt and remarkably consistent about what's happening. CEO Eddie Wu told investors directly that returns on these investments over the next 3 to 5 years are, in his words, extremely clear, and that Alibaba intends to keep spending aggressively because it sees this as a critical window of opportunity that won't stay open forever. He also revealed that AI-related annualized recurring revenue was on track to surpass 10 billion yuan by the June 2026 quarter and 30 billion yuan by the end of the year, evidence that the spending is starting to convert into actual recurring income, not just sunk cost. And there's a structural reason for the timing. Alibaba explicitly framed its self-developed chip strategy as a way to secure what it called autonomy over its compute supply chain, a direct reference to the global shortage of advanced chips and memory that's been squeezing every AI company on the planet, made worse for Chinese firms specifically by ongoing US export restrictions. In other words, some of this spending isn't really optional. When you can't reliably buy Nvidia's most advanced chips, and even the chips you can buy are subject to political risk, building your own supply chain stops being a growth strategy and starts being basic risk management. Alibaba's balance sheet can absorb the pain for now. The company held 520.8 billion yuan in cash and liquid investments as of March 2026. Enough, analysts note, to sustain the current pace of investment for multiple years without any structural stress. It even kept paying its annual dividend, roughly $2.5 billion in aggregate, throughout this entire period of negative free cash flow, a signal to institutional investors that management isn't panicking, even while the numbers look alarming on the surface. All of this spending is happening from a position of real strength, not desperation. Alibaba Cloud is the #1 cloud provider in China, holding roughly 37% of the domestic market according to analyst firm Canalys, well ahead of any local rival. Globally, that puts it in the same conversation as Amazon Web Services, which holds around 31% of the worldwide market, though on very different playing fields. Alibaba's cloud revenue growth has been accelerating, not slowing, even as the company pours money into building the infrastructure behind it. In the quarter ending in mid-2026, cloud revenue growth hit 26%, a 3-year high, and AI-related product revenue posted its 11th consecutive quarter of triple-digit year-over-year growth. That streak matters. It's one thing to spend billions on speculative infrastructure and hope demand shows up eventually. It's another to already be selling out capacity as fast as you can build it, which is closer to what's actually happening inside Alibaba Cloud right now. 8 new data centers came online in a single quarter alone, as the company raced to keep pace with orders. Meanwhile, products across Alibaba's sprawling ecosystem, from the Gaudi Maps app to the DingTalk workplace platform, are being rebuilt around AI features, giving the company a built-in customer base of hundreds of millions of users to funnel toward its own models, rather than a competitor's. This is the advantage that a company like Alibaba has, that a pure AI startup simply doesn't. It isn't trying to build demand for AI from nothing. It already owns e-commerce, logistics, mapping, messaging, and payments platforms used by a huge share of China's population, and it can bolt AI features onto every single one of them, generating real usage data and real revenue almost immediately, long before the underlying infrastructure investment has fully paid for itself. Step back and the picture becomes clear. Alibaba is running 3 enormous bets simultaneously, building its own AI chips to escape dependency on Nvidia and US export controls, giving away frontier AI models for free to win global developer loyalty before competitors lock up the market, and pouring tens of billions of dollars into cloud infrastructure to make sure it has enough computing power to actually deliver on both of those promises. Any one of these bets alone would be a major strategic gamble for a company of Alibaba's size. Running all three at once, while absorbing an 84% hit to core profit and a negative free cash flow position, is the kind of move that only makes sense if you genuinely believe, as Eddie Wu has said publicly and repeatedly, that this is a closing window that won't reopen. And Alibaba isn't making this bet alone. It's racing alongside Huawei, Baidu, and Sugan inside a broader Chinese push to prove that a completely homegrown AI computing stack, from Simi's 5-nanometer chips up through 100,000 card superclusters, can actually work at scale without a single component sourced from a company that Washington could cut off with an executive order. Whether that bet pays off depends on questions nobody can fully answer yet. Can Chinese-made chips actually keep pace with Nvidia's next generation? Or will they always be running a technological lap behind? Will giving Qwen away for free translate into paying customers fast enough to justify the spending? Or will Alibaba end up subsidizing the entire open-source AI ecosystem while extracting little value from it? And can the balance sheet really absorb years of negative cash flow if the payoff arrives later than management currently expects? For now, the market's answer has been surprisingly patient. Investors have watched profit collapse and kept buying the stock anyway, betting that Alibaba's full-stack approach, chips, cloud, models, and applications all built and owned in-house, is exactly the kind of moat that wins the next decade of the AI race, even if it means losing money on purpose to build it.